we have here 4 of the premier business brokers and intermediaries, and they're going to be talking to you about how deals die, how to bring them back to life. We came up with 10 different questions, and they're going to talk about answers really dealing with real life, what they've seen work and what they think can help you in the future, okay? So here's our list of panelists. Their bios are in there. The only thing we need to note is that Tom Whipple, because his name begins with a W, is first, and that's the first time in his life. So, all right. So let's talk a little bit about seller representation. And we often hear about sellers who want too much, going to the market with too unrealistic expectations. And do you take the client? Don't you? How do you manage expectations? And really, we have about 2 minutes per speaker, and we're going to have 2 speakers per question, and hopefully still have some time at the end here for questions from the audience. So George and Scott, can you address that?
Sure, I can address that. As far as, do we take them on or not, in our practice, we don't. We spend a lot of time up front setting expectations, try to set clear expectations. In fact, we probably do a little bit more than a lot of other firms that handle these size transactions. We bring in just to set clear expectations. We'll set an estimate of value ourselves, kind of at no cost, just to give a ballpark of, are we even in the ballpark to keep moving forward? And if we are, then we'll charge an upfront fee, and for that they'll get a third-party valuation done. We bring in an accountant who's a specialist doing a tax analysis. We bring in an attorney to do a consultation to talk about, is their legal house in order, and if there's going to be some seller financing, how is that going to work? How am I not going to lose all my seller financing if something happens with the buyer? To discuss those things. One thing that we bring in that I picked up from a gentleman up in Canada, Mr. Robbins is a business psychologist because again we handle mostly privately held, family-owned businesses, and at the end of the day, from a psychological standpoint, it can be pretty taxing where their head knows that they should sell, but their heart hasn't caught up with their head yet. So we've had some clients in the past that have pulled out halfway through the process. So we bring in a psychologist to make sure that they really, truly do want to sell their business and they know what that next chapter in their life looks like. We talk with lenders to take a look at the structure of what the structure might be. And then we bring in a financial advisor a lot of times to see how they might finance that money if there's a larger sum and they're going to retire their business. So we very much look at it from a holistic approach and bring in a large group of experts or specialists up front, and then use all of their results to put in writing our objective criteria agreement. It's not just what's the benchmark price, what's our commission, how long do we have. We break it down depending on each deal by price, how much money at closing, if there's some severe tax advantages or disadvantages, might be an after-tax number, what's included, what's not included, transition time. It puts more onus on us and our firm, but at the end of the day, we know exactly what we're all trying to achieve, and then we go to the market without, an asking price and see what the market will bear. But that's the best way that we can do it. Is if we're going to have any surprises, we try to take it on up front and not after we've got a couple hundred hours and thousands of dollars invested in it.
The question that was asked is a very philosophical question, and that's kind of a two-edged sword. And I think part A to answer that question is, what part of the career phase are you in this business? Are you in the early phase trying to develop the business? Are you in the kind of the senior stage? They have moments of seniority like myself and Tom, I'm sure, and Mike. So you need to make that determination. If you don't have a lot of deals to run with, it might make sense to do that and position it in the marketplace in a way that you're not embarrassed. Now, on the other hand, if you're a seasoned person and you have a client that has expectations that are unrealistic, when I have that, the real question in my mind is he a real seller? And what drives the expectation? If the expectation is I will sell only if I get my price, then you really don't have a whole lot to go with. And I think part of the issue is you need to kind of educate the client And one of the best points that a mentor of mine many years ago told me was that you need to inform the client that value is a moving target. And it depends on who the players are. So it's a value moving target. And you hear quite a bit about managing expectations, and you hear about it, but it's, it is difficult to manage expectations if you have a client that's not informed. It truly is. So I always ask, why are you selling? What's the reason for your selling? And if the answer is not the right answer, then you may not opt to, if you're busy enough, not to take on the engagement. The plus side of taking on engagements that may not meet the expectation is that at the end of the day, the managing the expectation is driven by the market. And perhaps when you go through the process, and it is a process for that seller as much as it is most likely for the buyer, that maybe greed will kick in somewhere during the process, and the expectation gets lessened.
Great. Now, Tom and Mike, let's continue with the theme of representing the seller. What happens if you have a seller, he's been engaged in the business the whole time, and then all of a sudden, after you're engaged, begins to check out of the business? You're facing declining sales or profits while you're trying to sell the business. What have you found are the most effective ways in dealing with that sort of situation?
First of all, I would say that sometimes you get poor performance even if the owner doesn't check out of the business. So that's a trouble. that's a problem either way. From our standpoint, I think we found it's important early on in the discussion process, even before we officially get a client, that we help them understand that we're there to do the work on the transaction, and his job is to run the business and make sure that he continues to focus on the business. This can be tough when an owner really doesn't play an important role in day-to-day, because he's going to continue on what he's doing, and if his subordinates aren't doing things well during that process, it can lead to problems. But on the other hand, if you get a guy who's pretty important in functioning in the business, this can be a real tough problem. Once we get underway in the process and actually are out in the market, we keep pretty close communication, not to involve them in the process after the book is done and we're out doing our work. We really don't need him involved, but we want him to be up to speed on exactly what's going on. And in particular, we want him to make sure he communicates any significant events that are going on. We require all the internal statements. Hopefully they're on a monthly basis. It seems like so many companies these days do such a poor job of tracking their financials internally, it can be a real problem. And we recently had a case like that, and what we did is I just made monthly trips to the accountant, and I made sure when he was compiling the internal monthly reports that we had a little analysis put together, and we did see some trends developing, and we actually educated the buyer on a significant negative trend that was going on. But I think that it's part of your job to make sure, as an intermediary, to make sure that your client does not do what you're talking about. Go ahead, Mike.
I agree with Tom. I have not run into a situation where the seller checks out. Usually it's the opposite that I'm often worried about, that he kicks in high gear, wants to pump up the sales, pump up the profits, cut the cost. And my approach right from beginning is just run the show as you always have. Don't mess with it, because if the buyer discovers it, that you really made up the sales by bringing in 5 more customers or pre-shipment or firing 2 people prematurely, you're going to get caught and the deal is going to fall apart. So I don't find that situation, Mark, where the seller checks out at all. They know that the value depends upon the profit and the performance and the continuity of it, and we educate them so much to make sure that that's where their focus is.
You mentioned the pre-LOI, and I would submit to you that that's probably a little late to anticipate issues and try to solve these issues. I think it's best to address those issues at the term sheet. When you put together the term sheet or you receive the term sheet, let's say if you're representing a buyer, to make it easy here, if you're representing a buyer and you get a deal and you look through it and it seems to make some sense, and rather than go directly to an LOI, and I know the attorneys will get all excited about that, I'd much rather go to a term sheet. And a term sheet is easy to put together, and it kind of sets a tone for the terms of the LOI. And in that term sheet, aside from defining what it is that you're buying off of a specific balance sheet or a bit of information income statement, you benchmark what it is that you're buying in terms of the equity position, with the anticipation that things are going to change down the line. And if you don't benchmark it, you have, I mean, sometimes these deals, you start in January and everything is hunky-dory, and by the time you get into the documentation is in July or later, and things move, and the initial value that was suggested is no longer applicable because of the balance sheet items that have changed or possibly the profits changed, such as inventory. I mean, inventory is always an issue, so anticipate that. I think if you're on the sell side, it's also important that you educate your client about these issues, that it's not new to him or her. So I guess the message is you need to anticipate those issues, inform and get ready for them, and have a basis on making the changes. And the last comment I would make is that Mike put on a brilliant course yesterday on balance sheet issues. And if you have not found out about what it is that he's done, he covers a lot of this stuff in detail. And it's probably one of the best courses that I've addressed in my career, and I've been, forever type of stuff. So you need to take a look at Mike's, at those facts. And I'm not getting any licensing here, but it's truly a nice piece of work.
Thanks, George. Mark, this is a very good question that you have, and as George said, this happens all the time. A fundamental approach I have is as follows. Due diligence is verification of information. That's the definition. Many of us have an LOI that gets quickly signed without details. Then the buyer or the seller engages the advisors to discover information. So my rule of thumb is 80% discovery before LOI, 20% verification before LOI, and the opposite after LOI. With that approach, what Mark is asking here is exactly what gets addressed and gets flushed out. At that time, tension is a lot less. I think over the years, with education increasing in the industry, the quality of the LOI details has increased, even though we haven't had maybe workshops as to what should be the content of LOI. But I do see, because of my software, people calling me and say, gee, deal is falling apart, and they haven't even covered the basic steps in an LOI. How do we fix it? I'll give you a specific example. I was involved in a printing company, S Corporation, $20 million gross book value of the assets, $10 million net book value of the assets. Buy-side representation made the offer, allocated $10 million to the purchase price, of the purchase price to the fixed assets, thinking that in an S corporation, let's avoid seller side recapture. And seller said no. And I said, why? He says, well, my book value is $4 million, tax cost basis. So he has a $6 million recapture, which is 20%, as you know, and that's $1.2 million in net to him. See, we flushed that out way ahead of time because they were not giving us the cost basis of tax return. So we tried it this way. It became an issue. Guess what? Get an appraisal. So it took us 3 months to get an appraisal, and the seller was right. The appraisal came at about $6 million, not what we thought would be at 10. And by law, we are supposed to give 6. How do we then do it? The onus was upon us, because now I have a lesser depreciation base, on and on and on, and we restructured the whole deal. And such issue, this is pre-LOI, 6 months before. After that was the tax issue on another side, on an S corporation issue. So my point here is that we will anticipate some such issues on a particular deal and try to flush that out as fast as we can, and sometimes it takes longer time, but I have found at the end of the day, when the LOI is done, it's more or less 80 to 90% guaranteed closing.
And that's probably the way we'd all like to see it happen, but in real life, we know that a lot of times things happen after the LOI stage. And Scott and Tom, can you address that a little bit in those situations where it hasn't occurred the way Mike tries to handle it? Some of the things you've seen and how you've resolved them?
How about that, Scott?
A little bit like George said, setting expectations up front. And when we're trying to talk with our prospective client, the seller, we'll talk through what some of those issues may be, and that it's normal for that to happen, somewhat normal for things to pop up, and we sit down and address them as long as everybody's reasonable. We'll work through it, so it's not where all of a sudden something pops up, they think they're the only seller that's ever happened to, and they think it's not meant to be, and they get a little bit emotional on us and take off. So we try to set expectations up front as best as we can and give them examples of different things that could happen. But once it does pop up, my always thought on that is try to get face-to-face. Get face-to-face with your client and sit down and talk through it and try to come up with a reasonable solution, and then get all parties together, the accountants, attorneys, buyers, sellers, whoever it needs to be, and sit around the table, because you can drag things on and hope and pray that the buyer will just keep going along, or the seller will all of a sudden change, but it typically doesn't happen. So you sit down and, try to get face-to-face, and if it doesn't work with that client or with that buyer, you can go back out to the market or determine what you want to do with your client. But that's kind of what we've done.
Sorry about the Packers last week, man, Yeah, I think Scott makes some good points here, and if I can just add on, pile on, as they say. First of all, I would say that it's been my experience that if you really are doing a top-notch job on negotiating your LOIs, you've built mechanisms for resolution of these potential problems into the process. And also, if you've really familiarized yourself with the operation, you've really identified the potential trouble spots ahead of time. And theoretically, you've highlighted them in your presentation of your memorandum or whatever, talking about the sell side now. And I think that if this process is rigorous as it usually is, that the reaction of the client is genuine relief, and they almost, well, my troubles are over now. This baby's sliding on into home plate. But that may be his position, but as we know, due diligence is, man, expect the unexpected. I think that the arbitration or the appraisal methodology is a good one to take advantage of. There's also something that works when you get an unexpected surprise. All surprises are unexpected, but and that's carve-outs. And this is fairly effective when you're dealing with asset heavy businesses. And I had an experience once where the old inventory, that's always the bugaboo, the black hole of value is the inventory in a company. And I had a chemical company that I was working with many, many years ago. And the solution we wound up with was that, the only part of the inventory was conveyed at the close, and the rest was subject to utilization over a period of time, and that we developed a formula for that and a payout schedule, and it became additive to the closing price, and that mechanism worked fairly well. And I think you can do the same thing in some other asset areas. The real tough problems are when there's an unexpected legal issue that arrives, or a shareholder in a multiple owner situation comes up, and those are really tough, and it really takes you as an intermediary to do what Scott's talking about, and that's pull all the parties together and really hammer out reasonable solutions. And I think your role in those circumstances, or our role as intermediaries, is to maintain a posture of we're just trying to be fair, we're just trying to be reasonable, and to make this right for both parties. And I think if you stay in that mode and try not to, it's tough to do because your client wants you advocating for them, but if you make it clear to them that he can't win if the deal isn't concluded, I think that posture will serve you well.
Just
Right.
one last thing, on that, and that's, it is, when you go into those meetings, when I try to get everybody together, and when you talk to both sides individually, and just talk about being, reasonable, and it's not a win or lose, but a win-win scenario. It's all cliche and kind of hokey, but when you can put them in that mood, well, of course, I'm a reasonable person, so, you just go in, at least starting off on a good note, and it goes a lot farther than just kind of coming in cold, sit down and go, okay, what's the first issue? Let's start talking. And then all of a sudden, somebody shoots off their mouth, and it's game on from there. So that's what I would recommend.
All right. Now the next one's a little bit trickier because here's a situation where you find out after you've been engaged, because obviously you would never have taken the engagement otherwise, that the seller has, lo and behold, misrepresented the business. All right? What do you do, A, with respect to your representation of the seller, and B, making sure you're not liable for the damages caused by the representation? So George and Mike, how do you handle it when someone's misrepresented the business, A, with respect to your representation, B, with respect to your personal liability in that situation?
Well, let's go back a few steps. Before that event happens, what happens at the time that you take on the engagement? And lawsuits, the longer you're in this business, sooner or later, you're going to get nailed with a lawsuit, not because you did anything, just because you happen to be around. I mean, somebody threatened me on a lawsuit even when they found out I wasn't Greek, that I was Lithuanian. I mean, it kind of gets a little ridiculous. But the message is that you need to kind of cover your backside, and you do that with the engagement. And the engagement that you write needs to spell out the obligations, your obligations, and what it is that you're going to do. Aside from finding the buyer or finding the seller, there needs to be language in there that you're not making any that you're not going to make any representation as to the correctness of the documents, and you guys know all that, all that language that needs to be in there. And the more that's in there, in particular language, a statement that you do not have a buyer in mind for this particular engagement. Bill Wentz suggested that I use that. The confidentiality agreement needs to address these issues about representation, that you're merely a courier of information. You're not making opinions on anything. And the more that's spelled out, the better off you are. In addition, I always make sure that the confidentiality agreement meets the spec of the attorney that's on that side of the deal. So he has copies of the confidentiality agreement plus a cover letter that's a short paragraph spelling out exactly what my obligation is going to be between other people. And you also need to spell out in that agreement what the obligation of the client is. I mean, you trust everybody, but you trust them with caution. And I think the key element is, the key point is that you need to pick your clients very carefully. I mean, if you've got a nitwit up front with you, and he's a nitwit for the last 3 meetings, chances are, the risk, he may be a nitwit down the line. So you get a feel, you pick your clients. I mean, you need to pick your clients, and I'm not sure that you can pick them and make a determination with one meeting. I think, you need to develop a relationship. And the more you do that, it doesn't eliminate the risk. The risk will never go away, but it certainly minimizes it.
I think the answer is simple. If a seller misrepresents, I sue him, I engage Marcus May, sue him for 3 times the sales. Right, Marcus?
Absolutely.
Okay. All right. I never had a situation where the seller misrepresented. Now, part of the reason is, of course, in the first meeting he does, or not explicitly. But if you engage him more and more, and you get the information from him, I think there are ways of finding out whether his story that he told us, or told me, matches with the financial performance. One tool that I use, and we kind of briefly discussed that yesterday, is the balance sheet. Balance sheet will tell you a lot more about the business than the income statement. In certain situations, I do make a statement that give me the balance sheet. I do not need to know the income statement to understand what's going on in the business. And we unfortunately only look at rarely, not even one snapshot of balance sheet. So I have ways of looking at it, and it says, what I should expect, what I am expecting as to what's going on in the business. And if the seller's statements, stories, etc., does not jibe with it, I know we have a problem. And usually by the time you ask a tough question, the seller who is interested in selling will open up and clarify. There was one time I did have a situation, and I did not take the engagement, and it was that the seller was, we all know that the sellers underreport inventory to increase cost of goods sold, decrease profit, to save taxes, common. And what I found was this guy was reversing that. So the reported EBITDA would look good. And there is no way to really verify that that's what he was doing, except a little bit more analysis. And I said, gee, this guy is running basically tight, he's old, 80-some years old. And he's 80 years old, approaching 80, and his inventory is increasing. He's not having a positive cash flow. His EBITDA and the increase in inventory more or less are equal. I said, how can this guy be that stupid to let that happen for 5 years in a row? And that was the clue. I asked him. He blamed me for not understanding what the numbers were, how they are prepared, that he's accountant and he had run legitimate life. I said, okay, I understand. He says, no. He calls me up, why don't you go and talk to an accountant? I did. Accountant agreed. And the seller still said I didn't know what I was doing. So I said, thank you, goodbye. So I did not take the engagement. That's when I learned 15 years ago that people do use that. And I have seen that more recently where people are reversing underreported inventory to inflate the profits. So my point is, in my case, I usually try to flush it out way ahead of time.
All right. And one of the points we also need to, we didn't touch on here, but need to make sure you understand is if you've already been engaged and then you find out and you continue to make representations based upon that misrepresentation, you may be liable for fraud. And so you need to be really careful about that. If it's not a material item, then you decide maybe your insurance covers it or something of that nature. But if it's a material item, you really need to look at it and you need to determine, is this time for me to withdraw before I help perpetuate a fraud which gets discovered on the back end? So that's something else to remember there. Now, what happens in a situation where you've got customer concentration? You always hear customer concentration is a red flag, or vendor concentration. What happens where you have a relatively small customer base during the course of your representation, client loses a key account or key supplier? What have you done?
Again, I think when you got the customer concentration issues, you've got to upfront talk about deal structure, and that's where we go out and talk with a couple different lenders and see what they're willing to do and talk with your potential client that there's going to be some seller financing or earn-out or whatever it might be, and again, possibly run through a couple different scenarios of, if you lose this, your biggest account, here's what could happen. Do you still want to move forward? And really try to talk with them about where they feel their clients are at. If it does happen where they lose their biggest client or a key client, what I've done in the past is immediately go to that. If we do have an active buyer that's engaged right now, go and talk with them immediately, get them that information immediately, and not look at all like you're trying to hide that, and give them the information, and then let them know that, hey, we'll work through this with, with the structure or whatever, we need to do. Again, talking with your seller first to make sure that he or she still wants to move forward, but I think to really try to get the information to the buyer as quick as possible and build a little bit of goodwill with the buyer. And then you take it from there. If the buyer wants to cut out, you do that, you redo your books and go out and talk to other clients, or possibly end the relationship with your client at that time, because it might just not, if they want a certain number, it's just not going to make any sense. So.
This happens many, many times, and I sold recently a business 2 years ago with a 100% concentration. Another one with about, we thought it was about 65, turned out to be 80% concentration. The 100% was a very unique situation. The seller had identified buyers. I said, I don't think they are the buyers. We tried, didn't work. The one that the seller had identified this was a supplier of a product, and the seller had, let's call it stolen the business, is not the right word, for a lot of unique business reasons, wound up having this business from this guy. So now, seller said, it's not a fit for me, I want to sell this. He will be the best guy to go back to. But how do you approach him, especially when he's upset? Our strategy, therefore, was to wait and find a way to talk to this guy without telling him who the seller is. And we were working through that. We had a couple of meetings. How do we know who he is by name and everything, but how do you approach him? Can we find a friend? Can we find a country club? Can we find bar that he goes to? We were just thinking about that, and I was just lucky. I was in the office of the LaSalle Bank, vice president. I meet on something different. I left and I saw this thing as a tombstone, and that bridge that did the introduction, and we talk about the relationships here. I told the banker what the situation is, and I says, banker, can you bring this guy in the conference room with one word, acquisition opportunity, no idea what it is. Come there, my seller would be there, then they will meet. And your reputation is at stake, so is mine. The meeting will be either 30 seconds or 3 hours. Because if they are really mad with each other, they'll shoot each other in 30 seconds. And that's exactly what happened.
They shot each other.
We were surprised. This guy didn't even know my seller. He just had her name, had no idea who the party was. And he did not know why the unique business circumstances of that customer created my client to wind up having this business. He had no idea, and when he heard that, anyway, my point here is that's a unique one, not duplicatable. The one that we did with about 80% concentration was basically that one had to be adjusted as to who the buyer is, who the seller is. In this particular, it was a private equity group, Mbbi member, and we wound up structuring a transaction which was a very low debt on the capital structure. PEG groups are just smart sometimes, and they conditions put it down. Not too much debt, overall less capital limitation. Therefore, seller would retain a lot of equity. We had multiple shareholders on the seller side. We found the one who wanted to play the long distance in terms of equity, etc. And our buyer wound up owning 51%, and then the 49% was retained in a very complicated transaction by the existing shareholders, incentives, and managers. So concentration becomes very difficult when you have a small company that is owner-driven. is owner-operator, and boy, it is tough to overcome the concentration, except for just pure contingency.
And these are only 6 of the issues that come up. We're starting to run out of time here. So rather than go into the 4 that you see in your books, if you have burning issues regarding those, catch up to these guys afterwards. Also, if you have any issues, give them a call later or something. They're very approachable, very knowledgeable. They're willing to help you just like they were helped when they started out in the business.